Main difference between trading and investing. The terms trading and investing can be confusing for someone who is just starting to step into the market. After all, investing is the act of spending money or the hope of generating some larger benefits in the future, while on the other hand, trading is the act of buying or selling investments. Grasping the difference between the two terms can be difficult, right? The terms used for two very different approaches to making money through investments. An average investor is someone who places his money in some company or business and looks for profits in the future, or he tries to gain shares of a company he's looking to be a part of. And a trader is someone who makes money in the short term by buying and selling stocks and generating money quickly. In other words, while an investor is largely dependent on gradual appreciation, the trader relies heavily on market volatility. Being a trader can mean many different things. Lots of companies hire traders so they can help the company out in several important investment decisions. For example, if a company decides to own the shares of an oil company or tech company, they will seek the trader's advice to gain the share at an appropriate and negotiable price. Another important factor that differentiates traders and investors is the analysis. Both the traders and the investors view the intrinsic value of a stock differently. For those of you unaware of the concept of intrinsic value, this is the actual value of the stock instead of the market rate. Now, there may be fluctuations in the stock's price. Some investors will try to buy the stock even though its value is below par. They will look for the long-term benefit, while the other investors will try to estimate the stock's intrinsic value, and they will try to hit the jackpot depending on their gut. While both these investment approaches differ, they depend on fluctuation of the intrinsic value of the stock. An investor depends on a broader understanding of the company before buying the stock. Traders, on the other hand, only focus on the stock price. There is no such concept as the intrinsic value in the trader's life, and indeed many traders, while buying the stocks, don't even know what the company is up to, and the short-term price swings are all they care about. For this reason, it is common for traders to focus on their analysis and technical indicators. Not to mention that some traders incorporate quality research in their analysis as well, but it is only for short-term profits and price swings. For example, if a company has announced to make a key decision in the coming days, the trader will go forward and buy the stock, as the announcement may come out fruitful for them. Some would even argue that a trader's life includes bluffiness, and they're generally good poker players. Those were the ways traders differ from investors. They're both two parts of two very different mindsets: trading and short-term versus investing and long-term. As we've discussed earlier, investing is a long-term strategy, where an investor is hopeful to acquire big dividends and shares in the future, while the trader relies on quick, short-term money. For example, when an investor buys a stock, he's looking to forward the price of the stock fluctuation in the future, and the investor will sell the stock at a greater rate to acquire significant profit. The focus is always on long-term profits. Traders, on the other hand, buy a stock and sell it for a greater price in the short term. Traders take advantage of the short-term price fluctuation to gain profits. It can be termed as the fast and furious approach. Trading and the speculation that the stock will behave according to its insight make traders focus mostly on small parts of the company's information rather than the understanding of the company itself and its operations. To put it simply, investors try to hold on to their stocks. They try to steer clear of the low market volatility. After all, having a long-term strategy is what makes you a better and a successful investor. Conversely, traders try to benefit from quick moves in the market prices. Traders always seek market volatility around key economic data releases, company earnings, and political events. A good instinct added with good decision-making ability is what makes a relentless and successful trader. Traders are always relying on day trading and swing trading. Day trading involves the individuals buying and selling the stocks on the same day, while swing trading expands the process to a few days, weeks, or months, but is never as lengthy as a process as long-term investing. There are other types of trading as well, but they all tend to follow in extremely small time frames. Sometimes the buy and sell take place in a matter of seconds. Difference between price and the value. To put it all in a nutshell, price is what you pay and value is what you get. Both price and value are two sides of the same coin. Understanding the difference between price and value is the core principle of value investing. Price is what the market wants from you. It is the price of the stock that the market has determined, while on the other hand, value is what you determine. The value of a stock is the price which you decide for a stock. Investors rely on long-term price and value relationships. On the other hand, traders rely on short-term fluctuation in the market, which can earn them booming profits. For example, for a trader, a stock's pricing is the amount on which both the parties, the sellers and the buyers, agree upon. The investing approaches might vary from investor to investor. There are two types of investors: active investors and passive investors. Active investor versus passive investor. If you're new to the game, you might see different investing strategies in the market. There are two types of approaches to a stock's price in the market: active investing strategy and passive investing strategy. To explain it in a nutshell, passive investors play a buy and hold strategy, while active investors actively try to beat the market. Passive investors tend to ignore the short-term fluctuations in the market, and they only benefit from the rising prices of the stocks in the future. They are dependent on the aggregate market in the future. While on the other hand, active investors are more closely related to the traditional traders. They try to estimate the stock's intrinsic value so that they can buy the stock for a cheaper price, allowing them to benefit from not only the price of the intrinsic value, but also from the return of the price to its intrinsic value. Both approaches differ a certain deal from each other, but one thing present in both of them is the dependence on the intrinsic value of the stock. For example, active investments usually are funds run by portfolio managers who try to outperform an index over time, such as the S&P 500 or the Russell 2000. Passive investments are funds intended to match, if not beat, the performance of an index. This means that their performance usually follows the market performance, since a lot of passive investors buy the indexes. Both these approaches are employed by investors to gain profits, whether short-term or long-term. So, to invest in the stock market without trading, you need to analyze and understand the company behind that stock. But to do that, first, you need to know that there are a total of 6 stock categories, and the way to analyze each of them differs. If you want to know everything about them, get our free ebook in the description below to improve your stock analysis and portfolio returns. Now that you know about the differences between traders and investors, which one do you feel more related to? Let us know in the comment section below. For those of you who stayed until the very end of the video, we've saved the best for last. We are going to give you pure gold and explain one of the many reasons here in 5-Star Finance we choose to invest instead of trading. When you decide to invest in the stock market for the long term, you mitigate one of the highest risks traders have: control over the investment. Even if a trader had the most brilliant insight about a company and allocated his resources because he expected that the stock would behave the way he anticipated, well, for the trade to succeed, first, the stock market would have to realize that discrepancy between the stock's price and its value. But the problem is that it may take a long time before that, so the short-term profit would probably fail. Now, let's assume that the stock market realized the discrepancy between the price and value in the short term, and the trade was successful. The next step would be to see the profit diminish by paying the taxes for capital gains. If you invest in the long term, you could pay 0% taxes. Check out the video we handpicked for you, and we'll see you in the next one.